Your chairman recently stepped aside from the business. He was a renowned gold bull.
And still is.
Yeah, I'm sure. Are you guys still as aggressive about gold as a company in light of his leaving, or has things changed?
We are. Things haven't changed.
Right.
We're still very constructive long term. We're going to shy away from any price targets today, but I would say that gold is a hedge for other asset markets. And after 6 years of strong assets everywhere, we think it'll have its place. It's a small market, so when people start accumulating it, it can have a very good price reaction.
I mean, is this a good entry point here? And where are you sort of weighting gold relative to, say, the beginning of the year?
Well, we're getting there. I think with this focus on higher rates, gold has clearly got some headwinds, and it's in a bit of a correction phase here. But as you just mentioned, speculative positions on the downside in gold have been increasing, which is a positive factor. So I think we're getting there. And for our equities in particular, the stocks in the markets that we follow, I believe they've been probably in about a year down cycle now. So we're getting to some very good price points.
And when you've got investors showing some element of caution about how the bond markets are trading and perhaps seeing higher yields in some of the bond markets globally as well, does that not give you any kind of pause for concern, particularly if it leads to a stronger dollar?
Yeah, it'll give us some pause in the short term, but long term, I don't know how long the economies can sustain and the markets can sustain higher rates before you start getting some reactions otherwise. And again, gold is usually quite a practical hedge when you get markets starting to move around a bit. So we've had 6 great years. I think odds are at some point higher rates will force some corrections, and gold will start reacting better then.